Welcome to all of you. It's a great pleasure to follow the President in kicking off this conference, the second annual conference of the ESRB. I'm Richard Portis. I'm the chair of the Advisory Scientific Committee of ESRB and co-chair of the Joint Expert Group on Shadow Banking. And it's in those capacities that I'm here and that I'm chairing the first session of this panel. Thank you very much. It's accumulating a lot of food for thought and discussion here, and Kern will doubtless add to it.
Thank you, Mr. Chairman, distinguished members of the panel, and attendees of the ESRB Annual Conference. It's a pleasure for me to be back in Frankfurt and at the ECB to meet with you and to discuss some of the issues related to legal perspectives on macroprudential regulation. But before I do so, I recognize that most of you are economists and finance specialists in the room, and I'm a lowly law professor. But I want to. This reminds me of an instance 20 years ago when I was a newly appointed lecturer at Cambridge University, and I was teaching company law and banking law in my first few years as an academic. And I was invited by a group of eminent economists from the Cambridge Economics Department and the Cambridge Finance Group to come to one of their research meetings. They were engaged in a research project on the regulation of systemic risk after the Asian financial crisis. The Asian financial crisis was just erupting, and they were working on it, and they were doing some excellent work in macroprudential modeling and trying to understand systemic risk in financial markets. So I was invited to this group, and I felt a little bit out of place. There were no other lawyers there. I was sort of a very junior member of the Cambridge Law Faculty at the time, and I didn't say a whole lot. And the chairman of our group looked at me, and he sensed the fact that I felt a little out of place, and he said, "Kern, don't worry. We've invited you to be here because you're here to tell us what we cannot do." And so I think in a way that's law has been viewed by economists as in a limiting fashion, that economists have big ideas. They do cost-benefit analysis. They try to devise economic policy, and they try to address these, in the case of regulation, systemic risk. How do we do it? But of course, we're constrained by law. We're constrained by institutions. And so what I'm going to try to do for you today is to try to put forth a little bit broader vision of what I think law can do. Macroprudential regulation is broad. It's about monitoring the financial systems. We've just heard two excellent presentations in which this is a concept that's been defined over the last 30 or 40 years in a rather broad way, looking at the structure of financial markets, linking monetary policy, fiscal policy, regulation, and also the design of institutions. Who should be doing what? And so I want to briefly mention those issues, but then I want to go into some of the issues that concern how will macroprudential regulation and supervision be discharged? I mean, how will these responsibilities, how can they be performed in an efficient way while adhering to principles of the rule of law? And so I'll talk about the issue of independence versus accountability. And I use the word the strong form of independence because internationally, most of you are aware that central banks in most jurisdictions are the institutions that are taking the lead in macroprudential policy and regulation. They play an important role in that area. Even now, the ECB is a bank supervisor as of 2013, and so we see, and the ESRB, of course, its secretariat is here at the ECB. But then I want to point out that that given this balance between independence and accountability, there are certain issues that central banks should be aware of, certain risks that they should consider regarding the exercise of macroprudential powers. And then I will mention very briefly some of the issues regarding the limitations of the ECB's role as a macroprudential policy institution. So anyway, the broad contours of macroprudential policy you've seen in the previous presentations. It touches on monetary policy, fiscal policy, regulation, supervision. The regulation is the promulgation, the devising of the rules and laws of regulation. Supervision is the exercise of discretionary oversight of the financial system. It's the decision whether or not to intervene, to forbear, or to apply sanctions in cases. And then finally, we've got internationally now the importance of resolution, bank resolution, and in Europe we've got the requirement for resolution and recovery plans. So the contours of macroprudential policy are broad. They touch on a number of areas. I've not mentioned the regulation of infrastructure, payment and settlement systems, and clearing. And we heard earlier Professor Portes talking about the issue of central clearing of derivative contracts, and when an exchange breaks down, like the MTS, it can create a financial stability risk outside of the banking system. So these are all areas that macroprudential regulation has been trying to address. Internationally, we've seen that a lot of progress has been made with the adoption of countercyclical buffers in the area of Basel III. We see that there are now requirements in the EU and US for central clearing of derivatives, also in Hong Kong and in Switzerland as well. And we see that internationally there's now been agreement on leverage limits and for both non-systemically important institutions, but also for systemically important institutions. And finally, the bank resolution frameworks, as I mentioned, they've been adopted. But there are some areas that have not yet been fully developed. And in the UK, they're looking at the issue of further macroprudential tools, loan-to-value ratios for banks when they make mortgage loans, for instance, or loan-to-income ratios. These are areas that are not fully developed. They're being examined by the UK Financial Policy Committee. But this is an area where macroprudential policy may be moving in the future. With respect to institutions, we see that everyone internationally, at least in the G20, has restructured regulation institutionally. In the US, we've got the creation of the Financial Stability Oversight Council, which is a systemic risk oversight body consisting of all the US federal regulators monitoring the whole US financial system. And in the UK, we see the complete restructuring of institutional side of regulation with the elimination of the old UK Financial Services Authority and the creation of a Prudential Regulation Authority housed in the Bank of England and a separate Financial Conduct Authority. And in the EU, of course, as Professor Portes has mentioned, we've got the European Systemic Risk Board, but also we've got the 3 European supervisory authorities. And so together, this institutional restructuring is designed in order to have enhanced monitoring of systemic risk across the financial system. It's designed to link up regulators from insurance, from securities, from banking, and from central banks and monetary policy so that everyone's working from the same rule book. However, there are risks. There are legal risk and regulatory risk. And some of the questions are systemic risk boards identifying and mitigating systemic risk in a timely fashion, including the risks that emanate from policymakers themselves. Regulation can be a source of systemic risk. We all know from Basel I how Basel I was focused only on balance sheets. It created an incentive for banks to shift their assets off their balance sheets through credit risk transfer, and was the birth of the securitization industry in the late 1980s, partially driven by regulatory capital charges and under the Basel I framework. So we see that it's not just the markets themselves, but regulators and their rules can create financial stability risk. Now in the EU, we've got, if one were in the European Union looking at regulatory policy issues, one might, if you're looking at it from a legal perspective, you could divide the legal structure of regulation into 4 areas. I would say the first area is competences. Statutes and create competence. They create authority for certain bodies to do certain things, to have certain powers. That competence might be plenary or it might be partial, but nonetheless, these competences constitute authority to oversee the financial system, to regulate the balance sheet of banks, to regulate the structure of the financial markets. Another aspect is the powers. The regulatory bodies have powers. And what I mean by powers are the ability to affect third parties, to affect the situation of third parties like banks or individuals in the markets. Regulators, by having competences, they can exercise powers to restructure the property rights of third parties like financial institutions. But with those powers can be broad or narrowly defined. With those powers come responsibilities. And the responsibilities can be viewed as obligations of the regulator not to act ultra vires, or the regulator itself in exercising its competence or its powers, it can be held liable for supervisory liability. And in Europe, we have a variety of different ways that supervisors can be held liable. And then finally, there are tasks. And the tasks are set by statutes, are set in policy objectives that are set by policymakers who could be finance ministries, parliaments. In the case of the EU, it's the Council of Ministers, and also working with the European Parliament. They decide and assign tasks. And certainly with the EC, and I have as an illustration, Article 4 of the Single Supervisory Mechanism Regulation. We've got the competence of the ECB as a macroprudential supervisor to act exclusively, to carry out for prudential supervisory purposes a number of specific tasks in relation to all credit institutions, what are defined as credit institutions, established in the participating member states. Supervisory competence depends on the identification by the European Council, the Council of Ministers, of its task, the assignments of what the ECB should be doing. And that's a way to hold the ECB accountable by assigning these tasks. And so some of those tasks are licensing, monitoring the institutions, and enforcing prudential regulations. So these are issues I think need to be addressed in the future. My last slide is about bail-in. Bail-in, of course, is the subject of numerous lawsuits around the EU now. It's the issue of the execution of bail-in has led to many investors, bondholders to sue in courts to say that their fundamental right to property has been infringed, and whether or not the bail-in decision was taken in a proportional way and that was necessary given the circumstances. And so the bail-in issue has led to many lawsuits. Resolution authorities have got liability risk there. And if the ECB were to play a role in resolution in the future, that would be a potential area of risk that the ECB would be exposed to, and as well as any other central bank. Resolution authorities are in central banks across Europe. In the UK, the resolution directorate is in the Bank of England. So the Bank of England has got ultimately supervisory, has got legal liability for any decision to impose bail-in or to take a bank into resolution that possibly might not necessarily should have been put into resolution. So these are issues that are a risk in the future, and the lawyers are here to help you manage the risk. And I think that, but these are complicated issues. I mean, the financial markets are complicated. The risk in the market derive from the markets, but they also derive from the way the law has structured the markets, and also from the decisions of regulators in the markets. And so I'm not really sure if there's a panacea or an answer to all these questions, but they do relate to legal risk in the future. So thank you very much indeed for listening.
And thank you, Kern. I think we can take